It takes us to our talk of the tape. How bad is it really going to get? Isn't that what everybody wants to know? Let's ask our panel for some answers. Avery Sheffield of Vantage Rock, Cameron Dawson, New Edge Wealth, Malcolm Ethridge of Capital Area Planning Group. Malcolm's a CNBC contributor. It's great to have everybody here. What's going through your mind? What do you think?
Yes. Yeah, very dynamic time, right? It seems like the markets are hinging right now on Trump and what he decides to do with the tariffs and every country's response. And so, given that uncertainty, we're still trying to look at where's there asymmetry to the upside and the downside. It does look like from the actions today that maybe things will be tougher with China because China's coming back with retaliatory tariffs. Maybe they'll be easier with Vietnam because Vietnam says, look, we want to really play ball. And so I think that things could play out differently by country. And given our exposure to imports in different businesses to those different countries, we could have very different outcomes for those businesses. Are
you looking to buy on days like we've just had, or are you afraid to buy because you're not sure where all this is going, as I said in the intro? Right.
So we actually are starting to see some opportunities both to buy, but also, we run long and short, but also to be continued to be short. And the areas that, we think are most interested are stocks actually in consumer discretionary that have been so beaten up. They're like potentially pricing in tariffs. So stocks that are down to kind of pre-COVID lows from like pre-COVID and more, but still more value oriented because we do think there'll be a trade down effect that we haven't seen over the past few years.
You think a lot of the tariff news, to your point, is already in those names?
I think a lot of the tariff news is already in those needs, and especially when you start to see countries like Vietnam saying we'll play ball because it's so important to them. I think that suggests that we won't have the worst case scenario. But even if we did have the worst case scenario, I do think that the bigger will get bigger. Like the retailers that have the analytics, that have the tools, that have the value proposition, that have diversified offerings from grocery, more staples to also discretionary, will probably be able to take share because this is going to be very difficult to navigate through for everyone.
Malcolm, I really do feel like people are thinking that when you're down, 2,100 points on the Dow now, plus what we did to the downside yesterday, are things beaten up enough that if I'm a longer-term investor, I should? It's easier said than done because the pain feels so bad, and you're not really sure where it's going to end.
So when you say longer-term investor, everybody's got their own different version of what that means, right? But I think that specifically for younger investors who are watching this and listening to us right now, this is the market that you've been waiting for. Since October 1st, I think, of 2022, the market's done nothing but go up and to the right, and you probably felt like you missed out on your opportunity to really build wealth the way your parents and grandparents have in this amazing growth engine that is the U.S. stock market. This is the opportunity. It's an unforced error that was handed to us by the U.S. president. And for anybody who's felt like they were locked out of this thing, you look back to 2008 and how many fortunes were created on the back of that great financial crisis. I myself graduated into that, so I had $10 to my name and missed that opportunity. This is similar to that for those folks who are looking at this. Very good quality names that have fallen off of highs by numbers we can't even calculate right now because the numbers keep bouncing on the screen. This is your opportunity to ignore the noise and the red on the screen, to your point, and get to buying.
What are we waiting for, Cam? Are we waiting for the president himself to capitulate on this, to the so-called Trump put, to not be able to tolerate this kind of carnage in the stock market any longer? Yeah. What is the moment?
We are hearing this constant refrain of a hope that you're going to see Trump back off. And maybe that's one of the reasons why we still continue to see this weakness in markets, because there is still that hope that maybe you won't see the follow through. I think it's also really interesting. We heard from Powell today. The Powell put is off the table. The Fed is not seeing this as a reason for them to step in and ease policy. So it really puts the put in Trump's court. And the question is, does he see this as a fundamental restructuring of the U.S. economy, which means that the tariffs are going to stay, or does he see this as just a negotiating tool to get some wins? It's a big, huge question mark, but probably the ultimate question.
Yeah. What do we think about the idea of a Trump put? I mean, we came into this year and after the election thinking, well, this is a man who cares deeply about the performance of the stock market, and his rhetoric over the last couple of days would suggest that not yet. Right now, maybe he doesn't. He's at his golf club. He's doing other events. He said things are going great, and he says things are going to work out. There's no sense from at least the president yet that he's had enough of watching his screen.
Right. Well, I think he said earlier this year that he's really focused on the bond market. And I think he's over the moon about the 10-year below 4%. Right. So he really wants to get interest rates down because interest rates coming down is going to meaningfully lower the cost of our deficit. And also it's going to spur demand. I mean, today you saw the home builders were actually up. Well, they're up actually for a legitimate reason. If you get interest rates down enough, you even had auto dealers up today, right? You can have these terrible auto tariffs, but if you're a dealer that can sell all different brands, sell more American-made cars rather than non-American-made cars, and interest rates go down, that's positive. So I think he feels like interest rates coming down and oil coming down are the two most important factors to drive more sustainable economic growth over the long term. And it does seem like he really doesn't care about the stock market in the short term. And to your point, I think he really wants to give those investors who've missed out on the stock market, the 50% of people who don't have money in the stock market, or younger people who've missed out on this opportunity, the opportunity to get in at much lower prices. I think he's fine with everyone who's made a killing to have to suffer and have a redistribution of wealth.
Well, he's getting a lower 10-year. As the Treasury Secretary has said repeatedly that they are fixated on, Malcolm, keeping interest rates low. The question is, do you come to a point of no return where you've hurt the economy bad enough through the wealth effect and the uncertainty and the lack of business investment and hiring, even though jobs report today showed a labor market that is reasonably resilient, though jobs are a lagging indicator, so it's really hard to glean too much from that. JP Morgan raises the odds of a global recession to 60%. There will be blood was part of their notation. Mohamed El-Arian, uncomfortably high risk of recession. Jeremy Siegel, biggest policy mistake in 95 years. Ed Yardeni getting harder to be optimistic. Editorials in, friendlier op-ed pages like the Journal, critical yet again of this sort of policy. What do you think?
If the president doesn't find religion over the weekend, and I mean literally in the next 2 days and come out Monday with some sort of reversal that we're talking about, it will be long-term effects and lingering effects. I don't know how we avoid recession, and I'm more concerned, forget the R word for a second, I'm more concerned about the S word, stagflation, where we have these inflationary tariffs, right? We're talking about a tariff rate going from about 2% in 2024 to about 22%, according to estimates, in 2025. That's the biggest tax imposed on American citizens in anyone's lifetime alive watching this right now, right? That can't be overstated. I think that it's very important that we consider what that means for us longer term, right? The put probably isn't coming, right? We know that this president doesn't like to reverse course on a whim like that because people are saying negative things. To your point, he's still golfing, right? So we have to consider the fact that this is probably long-term and lasting, which means that the playbook you came into 2025 thinking you were going to get to use, we have to rip that up and start over from scratch. Everyone who's sat at this desk for the last 5 years has talked about a stock picker's market. We're going into a stock picker's market, myself included. I think we're finally walking into that. To the point about the 10-year impacting mortgage rates, if I were somebody who was interested in buying the mortgage servicers, here's your opportunity to go pick some really good names. As an example, if I was somebody who was looking at tech, I don't know how you get a return in the stock market going forward without tech being included in that. I'd be looking at a lot of the tech names, but I'm not going to buy the entire market in aggregate with the Qs or something else. I want to pick the individual names that I've been watching and that I think are really great companies that shouldn't be selling off at basement prices right now.
So this statistic, Cameron, that I'm going to read you is just from Thursday. Mm-hmm. And given the declines today, you can probably double it. But the Mag 7 collectively lost $1 trillion in market cap on Thursday. Judging by the activity in a lot of those names, you're probably close to a repeat of that. You've had year-to-date declines that are so significant off the highs of 50% for the Teslas of the world and 38% for NVIDIA and so forth down the list. It's just ugly. Have they come down enough?
So on Monday, we published a bear market price target of 4,700 on the S&P 500. And we thought on Monday that that was a really scary number. We never thought that we would get that far, that fast. We're in 5% spitting distance of it. And part of it was recognizing that you still had a very high multiple and a lot of air to come out of multiples, given where we were starting on Monday. And a lot of that air is coming out of the Mag 7 and coming out of names like the big tech names. But you're still trading at 21 times forward in the big tech index. You bottomed around 19 times in 2022. So to your point, you're likely getting close. We do think tactically, given the degree of oversold statistics that we're likely to see in percentage of names at 20-day highs, put call ratios, flows into short ETFs, that you're likely near a tactical low or a tradable low in markets just because we've moved so far so fast. Does that mean that this is a V-shaped recovery? We don't think so. We think that you have dented this trend enough that you certainly could see more of an unwind post that bounce. But at least in the very short term, the degree of oversold suggests that you could see some kind of tradable bounce.
You know, the big question, I guess, is going to come down to what earnings end up being through all of this. I'm not sure you're going to get a great read starting next week. You will more so in the commentary than the numbers. If you look ahead to next year, as Wall Street obviously always does, and you've had Goldman come down from $280 on the S&P earnings to $269, and who knows if that's going to be legit or they're going to have to reduce again. 17 times that is $45.90. We're at $5,100. All right, I'll give you 18 times. Give you 18 times. That's $48.42. My point being, it's still significantly lower than where we are now, and we suddenly have so much uncertainty introduced in the whole equation of what earnings are going to be and what you should be paying for stocks.
Agreed. And I think there are still a lot of stocks that have very meaningful downside. I mean, almost the entire software sector, not all of the software sector. I mean, those companies' valuations are dramatically higher than the market. And
you still think they're too high?
Absolutely. And I mean, we're seeing, just checks even out through the past few days that there's significantly more increased business scrutiny on large software deals. And software is considered to be acyclical. It's actually acting very cyclically in the checks that we're hearing. Of course, we'll hear, in the earnings announcements and forecasts, you have a lot of other growth names that are trading, honestly, still on ether valuations that are economically cyclical. They've been seen to be secular growth stories because they have great, they offer services that people really like, that they're willing to pay for when they have a lot of money. But when they have less money, maybe people go to Kroger rather than asking for delivery, for example. So I think that there's a lot of movement still to come. Also in the luxury space, luxury names are still much more expensive in general, and some are very expensive on an absolute basis. And this wealth effect, you would think, would have some impact. So that's why we prefer, a barbell approach. Like we're focused on owning names that are already pricing in a lot of uncertainty. You're talking about multiples, even on earnings that are down maybe 50%, 10 times earnings. Like we're looking at buying stocks like that while shorting stocks that are very expensive and actually have underappreciated cyclical characteristics.
I want to take the other side of that trade. Sell me your shares, right? I'm looking at a company. Cameron, you just mentioned we're down to 20 times next year's earnings now on average in the Mag 7. 90 days ago, we were sitting here debating whether 30 to 40 times next year's earnings was too much to pay for these companies. We just saw Microsoft celebrating their 50th anniversary. Am I worried that Microsoft is going to go out of business in the next 5 to 10 years? No. So is this a great place to be adding shares of a company like that, a powerhouse in the tech space, to my portfolio? Absolutely. I think that realistically, the conversation feels like it has to be short-sighted, and we have to really think about valuation today. But I'm really thinking about locking in longer-term appreciation over the next 5 years, 10 years, and we are being given a gift in this market right now.
I would go as far as to say, I think when we're talking about some of the software names, that Avery's not necessarily talking about a Microsoft per se, but some of the other software names that have much higher relative valuations than a Microsoft does, ones that have gotten a nice AI lift. I'm not going to, I don't want to pull any names out of a hat.
Absolutely, yes.
But, there are cybersecurity related stocks that have gone up a lot. Am I correct?
Yes, yes. Yes, yes.
We also just heard from Microsoft, though. They were asked, are you overbuilding or do you need to pull back on capital spending? And Satya Nadella just said a few minutes ago, well, it does depend on GDP.
I honestly, that comment stuck with me as well. It honestly stuck with me right when he said that. I'm like, okay. So one of the bull cases was, all of this CapEx that these mega cap companies are going to continue to spend. Well, what happens if GDP falls out of bed? What happens if some of these calls that I have today of the firms that I read to you that are taking down or their growth estimates or raising their probabilities of recession? Do you think that those tens of billions of dollars that investors have counted on these companies spending are going to still be spent? I heard Nadella say not so fast.
Yeah, Microsoft makes software that goes into employment. So if you're seeing fewer people get hired, you need fewer licenses for Microsoft Office. If you have Meta is 98% advertising. Advertising is a cyclical business. Same thing with Google. Amazon, it's a consumer business. Apple, consumer business. Tesla, consumer business. This notion that these Mag 7 names are not cyclical and not sensitive to the U.S. economy is absolutely preposterous. Are they higher quality? Do they have better free cash flow margins? 100% yes, but we all still do breathe the same economic air.
It's true, right? As bullish as you might be relative to the declines, I think that's a perfect way of framing it.
So not to make this the Microsoft party, but I was listening to the earnings call last quarter and heard Amy Hood say something to the effect of, we've got about $300 billion in contracts that we can't even put on our books as receivables because we don't know when we're going to be able to build the capacity to meet that demand. That, to me, is a bullish signal that regardless of what is happening in the near term with the trade war, Microsoft is going to be fine. And I keep using them as my example, but I'm realistically talking about all of the big tech names that don't rely on the consumer, right? So Microsoft is not directly tied to the consumer. NVIDIA is not directly tied to the consumer. Anybody else like an Apple who has to rely on China and other parts of Asia, I understand the concern. But here, we're talking about software companies that aren't tied to the consumer, and they're going to continue to make those investments because they can clearly see where that's going to pay off.
Yeah, I mean, we talked software.